Hi, good afternoon, everyone. This is Clara Duran Reed with the Duran Reed Firm, and I'm really happy to be with you today. I'm so excited because today we have Dan Mon from the Estate Planning Group. Now, what I really love about this company, this firm actually, is the creativity and the financial success that they're always looking for their clients. So good afternoon, Dan. How are you?
I'm just great, Clara. How about yourself?
I'm doing great, thanks. Hey, thanks for joining me. This is exciting.
Yeah, thanks for having me.
Yeah, tell me a little bit about the estate planning group. And specifically, I know that you already do estate planning, but what is the specialty that we're going to be focusing on today?
Okay, so the estate planning team is a membership organization comprised of CPAs, attorneys, real estate professionals, financial advisors who have all gone through our training program and been accredited to market the deferred sales trust transaction to their clients and potential clients.
Okay, so it's a deferred sales trust. So that's interesting. Now I'm sure that this comes from the IRS code. So what section of the IRS code are we looking at?
So the deferred sales trust is built around section 453 of the IRS code, which pertains to installment sales, which at the end of the day is basically what this transaction is.
Terrific. So what really caught my attention was that the fact that there are people who want to sell their properties, but are considering not purchasing another property. They'd like to get out of the properties that they have for whatever reason. They might be retiring, they might be moving on, or whatever the reason is. But they don't want to be stuck with the capital gains taxes. So what does the deferred sales trust do for them?
So the opportunity for the deferred sales trust to come into play is when individuals are looking to, say, retire or just done owning property and finish with what we call the three T's, the tenants, toilets, and trash, and perhaps would like to travel or have some sort of need for medical expenses or the grandchildren's college, whatever the case may be. This allows them to sell that investment property, not have to exchange into a like-kind property, yet still defer the capital gains tax that would have been due had they not done an exchange in the first place.
Right. So instead of a 1031 exchange, this would allow them to almost accomplish the same as a 1031 exchange, which is to defer the capital gains taxes, except do it over a longer period of time. Is that right?
Well, it's a different animal. You can 1031 exchange and continue to defer as long as you own that property, and or you could use the deferred sales trust and continue to defer capital gains as long as you keep the proceeds from the sale of that property inside of the trust. So both of them have what you could say sort of unlimited terms to potentially deferring the capital gains tax. The differentiator is really the idea that you're no longer owning the investment property, you have more liquidity and options with what you do with the proceeds from the sale. And that comes down to a situation where if you were, once again, needing some sort of liquidity, you're able to get that with the deferred sales trust versus having to put all of the money from one property into another property in a 1031 exchange.
Okay, so the other thing that I found really interesting was that if somebody doesn't want to get all of their money right now, if they sell, they don't want to do a 1031 exchange, they don't want to get another property, but they don't want all of their money right now. What we're talking about is deferring it over time. And then the nice thing is the tax implications are that if the person were to get all of their money up front, they would have a larger tax bill than if they just deferred it over time and got payments over time. They would be actually paying less tax. And previously, you also explained to me, which was really interesting, is the fact that this can be put into an estate plan. And just like a property, it could be divided among the heirs. So if there are 3 children, 4 children, grandchildren, what have you, it could be a third for one person, a third for another, a third for a foundation, or what have you. And it's renewable, right?
Exactly. So it's a living object. The note that is initially written and issued by the trust to the original seller can be passed through the estate when the original seller passes away to any entity, children, grandchildren that they like. And the person who receives that note, when the term is up, we typically write these notes for a 10-year term. So every 10 years we would renew them. When the term comes up again, the person who inherited that note can renew that note again. So you could potentially defer those capital gains taxes over generations.
And so the monies that are put into this trust, I mean, they're gaining interest, right? I mean, they're growing.
Yes. So we work with the seller. You could sort of think of the seller as the bank and the trust as an entity that is getting a loan from the bank, which is the proceeds from the sale of the property. Mm-hmm. Well, the bank is going to want to know and approve what is being done with those funds. So in our situation, we work with the note holder to come up with a risk-adjusted portfolio of investments that will not only meet the income component of the note, because there is an income component that is paid to the note holder on an annual basis, as well as provide for growth or potential growth in the future. So we are looking to sort of have a total return of a combination of income and growth.
That's terrific. So let's just say a couple has numerous properties and they've decided now they want to travel, they want to give it over to their kids, but the kids don't want to take care of the properties. In an event like that, this note sounds like this would be great for the kids, because then the kids would have the income without the necessity of having to sell a property, distribute it, go through all of that. And then they themselves, if they want to, they can cash that note in. So it's liquid for them if they need it, or they could leave it there and continue on with investments. Is that right?
Right. So initially, the income and the note would be issued to the parents as the sellers of the properties. And then upon their passing, and this is where we would get the estate planning team involved to make sure that we have the structure in place to provide for the note to be able to be divided accordingly up between the children. And yes, they would receive their portion of the note, and one of them may want to sell that right away. One of them may want to take some and leave the rest in, and one of them may want to just leave all of it in. But it becomes their individual trust. So one trust would become 3 trusts, and that can pass through the estate, and they can continue to take income and defer those capital gains until whenever it is that they may or may not need the money.
And you work with the CPAs and other advisors of the clients as well, right? So,
right, absolutely. No, that's key, and I'm glad you brought that up. We really want the client, our potential client, the seller, to bring in their trusted advisor, the CPA they've had for 30 or 40 years, the attorney that they work with for their estate planning, if they're doing that already, anybody that they feel comfortable with as far as their financial life goes. We want them to be involved in the process from the beginning so that everybody knows exactly what is happening, so that everybody is comfortable with the transaction, and there isn't any sort of hesitancy that it looks like we're working with the client, but not with somebody that they've been working with for their entire life.
Right.
We want everybody involved.
Right.
And that's just, to me, that's just cleaner, and it just usually works out a lot better when the client CPA is involved and they go through the process of learning this, and the light bulb turns on and they say, you know what, I hadn't heard of that before,
Right.
but it's just because it's not my specialty, and
Mhm.
you can't know everything about everything. But if you're willing to learn, it could be valuable for them in their practice as well.
That's great. And then, so how many people have actually done this with the estate planning group?
So we've been doing this for over 25 years. We've
So
done
this is
several.
nothing new.
No, it's nothing new. 25 years later, we've done several thousand of these. There's
Wow. Several
over
thousand.
over $1 billion of assets in
Wow.
trusts, and we're doing more and more every day. So especially in this market now that we're in, we are finding, and the generation that we're in, we're finding that there is a very large group of people in this age group that are finding themselves at that crossroads. So, I'd really like to sell. I'm equity rich and cash poor.
Mm-hmm.
How can I do this without giving up half of what I've gained over the last?
Right. And then, and the seller maintains control in a sense over where the money goes, where it's invested in order to get that return back to them.
Right. Yes. The seller has to sign off on any and all investments, distributions. There is an attorney who is the trustee who oversees the trust, but he is basically working for the seller, the note holder.
Okay.
So the note holder lets us know what it is that they are looking for, and we try to match that with the appropriate investments.
Okay. Terrific. Well, is there anything else that you'd like to add?
It takes an open mind to sort of think about things that are outside of the box that you may not have heard of before.
And isn't this why we hire attorneys in the first place?
Exactly.
I know. I like the fact that I could use all the studies and information that I've gleaned over the years and be able to use it to be creative and to help my clients, financially and with their goals. And in this case, I like the fact that we can provide additional options. So this is one more thing that they can actually look at that perhaps it has not been offered to them before.
Yeah, and I think that adds a lot of value to your practice as well. Being able to have this in your pocket, as it were, to show individuals that there is sort of a door number 3. I mean, they don't have to exchange. They don't have to own an Applebee's in Houston. They can sell. They can defer their capital gains, have liquidity, and be able to control where and how those funds end up. And not, like I said, have to sort of deer in the headlights and not do anything, because that's really, in some cases, the worst option is that they just give up.
Right, because and doing nothing is a decision. Doing nothing is a decision.
I thought I was the only one that said that.
No, just well, great.
I agree with you completely. Not doing anything is a decision. And
it is a decision.
It's not always the right decision. So sometimes it is, but more times than not, it's usually not. So.
Okay, well, great. Well, thank you so much, Dan, for joining me today. I very much appreciate it. And if there's anything that we can do for you. And again, I'm Clara Duran Reed with the Duran Reed Firm, and Dan Moen with the Estate Planning Group. Thanks, Dan. Have a great day. Bye-bye.
Thank you.